welcome to Indianomics. The Independence Day weekend has been momentous for the Indian economy. Eventful, perhaps, is a more correct word. On Thursday, even before the weekend started, S&P upgraded India to BBB, one notch higher than investment grade, the best grade we've got so far. On Friday, the next day, that is, the Prime Minister announced that GST rates would be cut by Diwali. And over Sunday, our reporters were picking up that the US-India trade talks next week are postponed, which means the dreaded 50% US tariffs may happen after all, albeit for a short time. What does all this mean for the economy, for bonds, and for the cost of capital for companies, for their appetite to invest? I have with me ace banker and bond expert Neeraj Gambhir, Group Executive and Head Treasury Markets and Wholesale Banking at Axis. We have also got economist Sonal Varma, the Managing Director, Chief Economist at Nomura. We have Kanika Pasricha, the Chief Economist from Union Bank, and Narang, the economist from ICICI Bank. Ladies and gentlemen, thank you very much indeed for your time. Well, first let me get the macro picture, then we'll get to the bond picture. Sonal, the rating upgrade and the GST cut consumption boost. One is a capex boost because it brings down the cost of capital. One is a consumption boost. Are you changing your macro growth numbers?
No changes as of now, Lata. I think there are lots of moving parts. The rating upgrade, of course, is an acknowledgement of what's been going right in India. So it's a sentiment booster, might lower the cost of capital for some companies. But in terms of a substantial change in capital flows, etc., I think there are other factors that are offsetting that. The most important being the US-India trade talks and the likelihood that the higher tariff rates are likely to stay for a while. So the impact of that on exports and investment is something which we will see September, October onwards. The GST is a positive surprise. I think typically what we've seen in the past when such tax cuts are announced is that consumers postpone their consumption decisions in anticipation of lower prices. So we could see a softer patch in terms of durable consumption in the run-up to Diwali and a bigger boost after that. So on net, lots of moving parts. As of now, we are still at 6.2% for FY26, and risks we still see skewed to the downside.
Okay. Kanika, your views? Overall, there is a negative from the tariffs probably for some time, but a positive in terms of consumption boost. Where do you stand in terms of growth?
So, Lata, I completely agree with what Sonal said. There are a lot of moving parts, which is why we never changed our growth forecast as well. We maintained it at 6.3% from the start of the fiscal year.
Okay.
While 30 basis points is a direct estimate impact of that 25% tariff hike, we would also want to await the GST booster shot coming in the form of consumption once the taxes kick in from Diwali. But yes, details awaited A, and B, on tariff talks also, whether any penalties are imposed, because there are also news that the US authorities are not coming to India. That needs to be closely watched. So yes, moving parts. But I would just want to add one thing, maybe from growth perspective, there is a sentiment hit of these tariffs. So maybe the growth impact is delayed from these positive stimulus measures, but direct inflation impact may kick in from December quarter itself. It should be a positive to watch. Thanks.
Fair enough, of course. Samir, your thoughts? I mean, people were talking about a 0.6% or 0.4% GDP impact even when it was 25 basis points, the tariff hike. Now, 50 at least for some time is a possibility. So what, do you leave your growth numbers unchanged?
No, I think, Lata, when we started the year, we had downgraded the growth estimates because of weak growth outlook. Then we upgraded after the front loading of monetary policy. And post the incremental tariffs, now we stand at 6.3%. We've lowered them a tad bit by 10 basis points again. Now, both these events of higher tariffs, as you correctly mentioned, the overall hit of 50% tariff for part of the year will be lower. For a 12-month rolling basis, of course, the number that you mentioned will be on the higher side, maybe 0.7, 0.8%. But there are a lot of mitigants as we see. And one of them is the GST announcement that has happened. That is one. And the second thing is that, even in case of China, where tariffs have been very high, re-exports have happened from other geographies. So it is very likely that in India's case, at least for the larger set of producers which are part of the supply chain, be it for gems and jewelry and even for textiles, there could be re-exports happening from other geographies. But for MSMEs, the impact would be larger. So on an overall basis, our sense is that the optical hit looks much higher. The eventual effective hit will be perhaps half of it. So our number is around 0.4% of GDP.
Okay. Well, the point is it may not be very growth positive considering so many factors may cancel out one another. But it's certainly a stock market positive because the GST and the income tax cuts are going to be EPS accretive for sure. And most important will be the cost of capital. To you, Neeraj, are you expecting we already saw a steep fall, a good, 7-8 basis points fall in bond yields on Thursday itself because bond markets could still take advantage. But today the yields have gone up from Thursday lows because of a feared fiscal impact. So net, do you think cost of capital goes down for companies?
Sentiment-wise, it's very positive. I think the S&P rating upgrade was a bit of a surprise. I don't think anybody in the market was expecting for it to happen now. If anything, there were expectations maybe next year we could see a rating upgrade. But the fact that it has happened now is obviously a positive for the sentiment in all the markets. The impact on flows will be a bit muted at this point in time, given the other, macro variables, particularly on the trade side, has been mentioned earlier, they play out. Bond markets, I think for now, have taken about 5 basis point net gain over yesterday and today, or the previous business day and today. I don't think we materially change from here unless and until some of the other things play out. The tariffs, playing out will have a bearing on the currency, which eventually will have a bearing on the flows. And therefore, I think that market will wait for some of these issues to be sorted out before, changing the direction.
Okay. But what about, your own sector, Neeraj, along with the sovereign rating being raised, all financial institutions' ratings are also raised, those that have a global rating, like State Bank, etc. The rating has already been raised. Likewise, we already hear that a lot of NBFCs are beginning to raise global capital since it becomes a tad cheaper. Can we say that the financial sector as a whole is likely to get slightly cheaper capital than we expected, say, up until Wednesday?
So not everybody in the financial sector is borrowing externally. Some of the public sector banks borrow externally to fund their offshore locations. And we have seen about 10 to 15 basis point tightening of the spreads in the dollar bond market since the rating news has been announced. As more and more of Indian companies, including the NBFCs, tap the overseas market, given the fact that we now have a BBB rating, will certainly help them raise higher amount of funding at a slightly tighter pricing. So yes, net, to the extent that financial sector is borrowing from external world, there will be some benefit in terms of pricing.
Yeah, actually, in our zest, we are forgetting. Look at the way the financial stocks have moved today. This morning, Bajaj Finance, Sundaram Finance, Chola, M&M Financial, Shriram Finance, all of them up between 3 and 6%. So clearly they see a cheaper cost of capital coming their way. Will that, PFC, REC, I think will be the biggest beneficiaries because they are always borrowing abroad. You don't see any capex impact of this, Neeraj?
I don't think rating per se impacts capex. Rating, as I mentioned earlier, that improves the sentiment.
Okay.
It makes it easier for the financial institutions to lend to the companies in a country, particularly the external world. But I think capex has several other dimensions to them. And I think at this point in time, the tariff-related uncertainties are the bigger play. And once they are sorted out, only then I think the capex cycle can have some positive impact.
Okay. Let me toss that to the economists. Sonal, what's the sense? There is this expected consumption boost, especially cement. I mean, it's been at 28%, and there is a very good chance it's going to come down to 18%. Likewise, small cars, two-wheelers, very clearly those are, would that trigger a capex boom as well, considering that the cost of capital is going to fall? Not boom, boom is a strong word, but it trigger capex.
I mean, I think in the overall scheme of things, Lata, right now, first and foremost, we need to see certainty on demand, both in terms of consumption demand certainty going forward and visibility on external demand before that triggers any capex boom. What the GST cut does is it will bring down the price of items that are considered more essentials in nature. And so to that extent, there could be some boost at the margin to consumption demand. Although, as I mentioned, most of this will come after Diwali. We could see some moderation ahead of Diwali. The more fundamental drivers of consumption ultimately will be the ones to watch, what's happening on job creation, how are wages and salaries moving. Lowering prices is one of the factors that drives consumption, but of course, not the only one. Similarly, on the exports, things look like we are going to see a moderation in our exports to the US. So I think it will take a bit of time for us to basically say that capex revival is here.
Okay. Actually, I forgot to ask you all the other big question, economists. What about the fisc, yaar? Sonal, would you think that what S&P is giving us in one hand, we may be losing by increasing the fiscal deficit?
We don't know, Lata. I think everyone's jumped to the conclusion that this is a massively fiscal expansion, but we don't know exactly what the fiscal impact will be. While bulk of the items are moving to the lower tax slab, what the revenue share is, so not the volume, but the revenue share of those items is also important because states will not want to lose any revenue from any GST rationalization. So if we are moving more items into the lower tax bracket, but some big revenue contributors to the higher tax slab, the net fiscal impact actually may not be as negative as is being feared. It will still lead to disinflation because the share of these essentials is a bigger share of the overall CPI basket, but it may not be as negative on fiscal is our sense.
Okay. So the bond yields, however, have moved up on fears that there can be a fiscal impact of the GST cut. But, there were also expectations that a small package, a temporary package, may be given to exporters who are being hurt by this likely 50% tariff from the US. Is there space for that? All those questions to my guests after this very short break. We are back on Indianomics. Welcome back to this very special Indianomics. We've been discussing the combined impact of an S&P rating upgrade, a likely GST rate cut for a whole host of items, and possibility of a segment of Indian consumer products reeling under 50% US tariffs. All the combined impact we are discussing with Neeraj Gambhir of Axis Bank, Sonal Varma of Nomura, Kanika Pasricha of Union Bank, and Narang of ICICI Bank. Before the break, we were talking about whether a fiscal package can come for the exporters now that the government has already given away some of the money or is going to give away some of the money by way of GST cuts. So that question to you, Samir, do you think now even hoping for a package for the exporters is difficult? Or, will the government go ahead? After all, who is respecting fiscal boundaries these days? Look at Europe, look at the US. I mean, maybe 4.6, why not? Do you think the government might take that posture?
So I think, Lata, for exporters, the benefit will flow through credit lines, through credit guarantee, and through other schemes like maybe interest equalization schemes, softer credit terms, maybe some support or nudge through some of these factors. Risk weights can change. So there are many other tools apart from a direct fiscal handout, which will be given to the exporters, diversification, working on newer markets, helping them out in many other ways. So I think that would be the route taken rather than a direct fiscal handout that will be given. And the cost of that is defrayed over the years, as we have seen during pandemic as well, when the credit guarantee and other schemes were given. So that cost is defrayed over the years. It's not a one-time cost. So I think we should think on those lines, and that's what happened in Brazil as well, where credit guarantees and other schemes have been extended because they are also on a 50% tariff as we speak.
Okay. One would strongly argue that this is a penalty on India, but it is being borne by some exporters who are accounting for 50 billion, and they're all extremely labor intensive. Gems and jewelry, textiles, leather, all three very labor intensive. So some lakhs of workers are going to pay for something which is a national penalty. So, what are the bets, Kanika, that there can be a package and there will be a package?
So, Lata, first and foremost, in terms of package, like Brazil has given some $5.5 billion direct package for exporters. The numbers that you're talking about, possible. But I would still completely agree with what Sameer said, and this was done way back in COVID as well, that whenever the government has attempted to directly protect MSMEs, exporters in times of global growth slowdown or these tariff hikes, it's mostly in the form of guarantees, even though it's 100% government guarantee. And that does not have direct fiscal impact or a significant fiscal impact in the first year. In fact, I would want to just make one more point in terms of GST as a reform. While the market today is debating that the near-term fiscal impact can be significant because a demand kicker comes with a lag, but the medium-term impact is very positive, which is why the question that you were asking, Neeraj. So while 10-year yield today is up 5 basis points, 50% retracement of the rating upgrade impact, the 30-year bond yield is down 5 basis points.
Okay.
Because it's a medium-term positive. So there are other levers. And of course, as you said, that the RBI dividend impact, some 50,000 crores extra that they got can offset even if they come up with a direct package for exporters, A. B, for GST also, the compensation says is budgeted to rise from 60,000 crores last year. The compensation says fund amount, outstanding amount after accounting for GST, GSEC redemptions.
Okay.
That is expected to rise from 60,000 crore last year to 1.2 lakh crores this year, to be equally possibly divided between states and center.
Okay.
So there are some buffers to offset fiscal impact even in the near term and maybe pay for that exporter package, if any. Thanks.
Okay. No, other things apart from what you're saying, I would strongly say that this is very different from COVID. COVID hurt all of us. COVID hurt all MSMEs. But here you have a specific set of exporters which are labor intensive and, for no fault of theirs. It's not a marketing issue. It's clearly a political issue. And I would think that if a package for specific companies is called for, this clearly is one. It's something the nation should stand up for. But Neeraj, all told, do you think the bond market is not going to be as celebratory as it was on Thursday when the news just came? We were expecting that things would only get better from here on. There was a very, very cheerful sense. Is that going to be dulled because, there could be a package for exporters, there will be a consumption boost because of GST cuts? So is the Diwali over for bond markets before it began?
So I think for the bond market, there are 2-3 things which are at play currently. One is that we are clearly looking at the end of rate cutting cycle. Maybe there is one more rate cut, maybe there's not. We don't know, but clearly a big part of the rate cutting cycle is behind us, and the market has already discounted that. We have seen a significant steepening of the yield curve, approximately 100 basis points in this cutting cycle, which basically tells you that the market's expectation of further rate cuts is kind of dissipated. Secondly, on the fiscal front, ideally we should not be talking about government abandoning its fiscal conservativeness on the day when we have received a rating upgrade. And we received the rating upgrade precisely because we have been fiscally conservative, right? I think that's a requirement from S&P. So I do expect that, having seen the benefit of that conservatism, the government will continue to be, very mindful of the impact on the fiscal of anything that it does. And I completely agree with the previous speakers that any intervention by the government to support some of these sectors could be in the form of easier flow of credit by way of guarantees rather than providing direct, financial help in some senses.
Okay.
So I think the upside for bond yields is limited given the fact that direct fiscal impact is likely to be limited. But frankly, there is nothing positive for the bond market to look forward to at this time.
No, I agree with you that if even if there is one more rate cut for the bond market, it is anticipation of being in the start of a cycle that gives gains. One more rate cut is not going to really cheer, not the 10-year for one. But isn't there space for a rate cut, Sonal? Considering that GST is going to bring even CPI down, doesn't it absolutely increase the chances?
Yes, there is room and, in fact, need for rate cut, but not GST-driven, Lata. I think the typical, the price level, let's say moderation because of GST tends to be a one-time adjustment. Monetary policy does not respond to the one-time adjustment. What we need to focus on is the medium-term outlook on both growth and inflation. So on growth, I think let's say the positive from GST, the lagged impact of monetary policy versus the negative shocks that will hit us on the tariff and the uncertainty and the other channels of indirect spillovers. Our view is RBI's projection of 6.5 is optimistic, and we see downside risk to that. And two, on inflation, I think the 3.1% that the RBI has set, our own forecast is through 0.7% for FY26, not accounting for any GST changes. Okay. The important message actually from the July CPI was that after 2 years of disinflation, we are actually seeing early evidence of further disinflation in the core categories. And I think that basically suggests that inflation remains significantly below the medium-term target of 4%. So we are still expecting a terminal rate of 5%, so 2 more 25 basis point cuts from here.
Unfortunately, running out of time. So economists, just tell me your rate cut expectations. Neeraj has more or less said that he's not expecting. What about you, Kanika? Not much time, so quickly.
So token 2550, Lata, timing contingent on when growth fault lines.
25 or 50?
I would say 25.
Okay. Samir?
No, we don't see a rate cut.
Okay. I think bankers don't want the rate cut because they've had enough of margin compression. I guess there is an emotional element creeping into the ICICIs and the Axis at that point. But honestly, the fiscal part, if there is a fiscal crunch, it is going to hit the states more. And it is the states where the capex happens more than at the center. So, there are more dimensions to this unless we know the entire package. One should expect a raucous GST Council discussion because the states are not going to swallow a reduction in their revenues very easily. And such large GST cuts in the past have always happened by consensus. So, we are going to see a lot of uncertainty on how much GST cut, who bears the burden? Will it be the states? How much? How does that impact capex? A lot of unanswered questions. So to blindly say that consumption and capex will receive a boost is perhaps too much. But consumption clearly getting a leg up from the complex of announcements that came over the weekend. Thank you very much, Neeraj, Sonal, Kanika and Samir, for improving our understanding of the economy and the bond markets, but a lot of loose ends, a lot of moving parts. Let's see how things shape up for the economy. That's it on Indianomics. Thank you very much for watching. Stay tuned for more.